Welcome to Drill Down Earnings. We have second quarter results from Box. This is the business story behind one stock on a move. I'm Futurum Group Chief Market Strategist Cory Johnson, and we like to look at the business behind the stock on a move. Telling you what is a beat or a miss isn't enough information. It was a beat. Okay, great. But let's look at the actual business, what the business did. And these were numbers fundamentally that I would characterize as not bad. And not bad is actually good because maybe there were concerns about bad, but the numbers are getting better for Box. Specifically, $270 million, up 3% on a year-over-year basis. GAAP operating margin, 7.5%. And profits for this company. They're also extending their stock repurchase. Let's dig down into all those things. So first of all, as I mentioned, 3% revenue growth rate, not as much as last quarter, but the decline of the revenue growth rate has been persistent in this business as we go back really over the last couple of years. So kind of above 2.5%, above 2%. It's kind of where it's been hanging here for the last 3 quarters, and that's good news because things aren't getting worse. At least not much. And they've had really kind of solid growth in their billings. Their billings up 10% on a year-over-year basis. That's very encouraging, right? Think 3% revenue growth, 10% billings growth, which means some contracts are starting to get a little bit bigger. The numbers in the future might be a little bit better. And if you go even beyond billings, if you look at their RPOs, the remaining performance obligations, so not just the deferred revenues on the balance sheet, but the deals they've got signed. They don't have the cash in hand yet, but they've signed deals that are so big that they actually saw a 12% increase in their RPOs. That's fantastic news for this company, with revenues growing at 3%. But really, think of RPOs as the future number, which is 12%. That's a good number. And then, their profit margin's better, as I mentioned, up. So their cost cutting seems to be working at the company. The RPOs, the future billings, are looking better and better. And then profit margin's better. Then add to that a share buyback that has been bringing down the shares. Shares were down. The share count was down 1.5%. In the quarter that they're just reporting here. But they've also authorized another $100 million to buy back shares from the board of directors. Will they use the full $100 million? We'll see. But if they're opportunistic about this and reducing the share count seems to help, certainly the insiders and the co-founders who are still there want to see a smaller share count so they can own more of the company. Who doesn't like that? Look, the market liked these results. The stock was up 6% in after-hours trading. And after losing 6% for the year, yeah, I guess you could have just put your money, put it in a pile in front of your desk and stared at it all year because you lost 6% for 51 weeks and 4 days, and here we are right back up 6%, right back to where we started. So what does this mean for one of those founders, one of my favorite CEOs of all time, Aaron Levie, who's done a kind of a remarkable thing for this company? And there is still a conversation, why does the world need Box when you've got Google Drive and you've got Dropbox and you've got Microsoft's cloud offerings? And the answer continues to be people prefer to use the better service, the simpler service that they find in Box. And Aaron Levie is, of all people, the biggest proponent of that story.
We're very happy with the execution in the quarter. The team delivered strong results really across segments. I think we still see, some degree of incremental pressure in areas like, not incremental, but relative pressure in areas like SMB, and a couple kind of regional segments. But when we look at the Q2 performance, it feels like, relatively stable compared to, let's say, Q1 and the general trends we've been seeing. And overall, I think it was a quarter driven by demand for Box AI and our Enterprise Plus plan. So the teams are very much focused on continuing to drive both new logos and upsells into the E Plus plan, and that momentum just continues, relatively unabated, which is great to see.
So there you have it, right from the lips of Aaron Levie, who is still running this company and returning this company to growth, as I mentioned. And lots of all the different numbers that tell us that story to be true. But the one number that tells us a whole lot, the Drill Down Earnings Bite, right after this.
The Drill Down is brought to you by Futurum Group, where analysts, researchers, advisors, content creators, and marketing experts help business leaders anticipate and understand shifts in their industries and build strategies to leverage disruptive innovation. With deep analysis, Futurum Group's extensive industry experience delivers reliable research and data, thought leadership, and actionable advice to help you with your strategy and go-to-market efforts. Futurum Group.
So Box just reported second quarter earnings. Wall Street likes them. Why? Well, here's your essential drill down summary. $270 million in revenues, up 3%. And while a 3% gain is a good thing, especially with improving profit margins, the drill down bite tells you the real number, the one number that means a whole lot. And that is the RPOs, the remaining performance obligations, up 12% on a year-over-year basis. So revenue's up 3%, but RPO's up 12%. That's really good news for the future of Box. All right, thanks for listening to Drill Down. I'm Cory Johnson. And you can check me out on Twitter @CoryTV and on TikTok and Instagram @DrillDownPod.